Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello and welcome to another episode of Fidelity Soundbites. Something a little different this month, in case you haven't noticed. I'm not Lucas de Popove. My name is James Gruber, and I'm the editor of investment newsletter Firstlinks, published by Morningstar, and I'll be your guest host for this episode. I'm being joined by someone considered a veteran in the Asian equities space, Anthony Srom, portfolio manager for Fidelity's Asia Fund Strategies. Firstlinks and Fidelity have a relationship that goes a way back, and Anthony happened to be in town and I was interested in catching up with him, and this gives me the opportunity to do so. Anthony, I don't think our paths have crossed before, even though we both started working in Asian equities at a similar time. I was an equities analyst with broker CLSA across different Asian countries from 2005 to 2010, and you started with Fidelity in Singapore in 2006, so I'm sure we know of people in common, but it's nice to finally meet you in person.
Likewise.
Let's talk about a few big picture items. First, tariffs. How are you thinking about them in an Asian context?
Pretty interesting question. Well, you've had a Liberation Day sell-off, as everyone would have seen, in March, April. How am I thinking about it from here? Higher level of uncertainty. So do we kind of settle at lower levels? Everyone walks away with a face-saving win, Xi Jinping, Donald Trump, or is there still some argy-bargy left to go? I'm unsure. But tariffs aside, if we come up with something that's not satisfactory to both parties, the risk I see is that maybe the US, specifically Donald Trump, comes at China with something else that's non-tariff related. So to answer your question, I don't think we're entirely out of the woods between the China-US relationship. Tariffs seem to be progressing in the right direction, but I'm open-minded.
You mentioned non-tariffs. What are you thinking there?
Oh, it could be expansion of the non-reliable list or entity list. Could be sanctioning parts of the Chinese economy, for example. So I think there's a lot of other avenues that the US could exhibit aggression towards China should they wish.
Have you adjusted your portfolio in response to these tariffs at all?
The answer is yes. There was addition to the portfolio as a result of the tariffs. So you saw the steep sell-off, as I mentioned, in March, April. I thought that was an opportunity for the fund to add to an existing position, being Tektronic in Hong Kong. So you're adding on weakness just to maintain the active bet that fund is running. I also saw a opportunity to introduce Tencent into the portfolio. So if you look at Tencent going into Liberation Day, let's call it mid-500s per share, it gets absolutely smashed down to about 420, 440. Which takes it back to almost the pre-DeepSeek days of January, with the benefit of knowledge of DeepSeek and AI application for their business. I thought that was a pretty good risk-reward opportunity. Fund stepped up meaningfully. It's about 8% of the NAV of the portfolio now, and you've seen it re-rate since then. So early days in the thesis, early days in the investment, but the fund used, let's call it, the noise around tariffs to actually add.
I was going to ask you about AI, so that's a nice segue. How are you thinking about that and the impact it could have on Asia and the stocks in your portfolio?
From an Asian perspective, negative. From a perspective for the portfolio, a positive. Let me elaborate. So the fund is very much underweight technology. It's the largest sector underweight. Double digits, active position. So if I wind back the clock about 18 months ago, 24 months ago, it was the largest sector overweight. I sense there's a lot of froth, excess positive sentiment still attached to technology, specifically AI. When I talk to analysts in the region, look at research, I think there's a lack of recognition around risks attached to AI and how that could play out to a lot of companies' financials and others' investment theses. So there's only one stock left in the portfolio that will be technology related, being TSMC, and that's underweight. In terms of why I say you would be a beneficiary at the portfolio level, should I prove correct, let's just take that underweight as what I've just mentioned. But I think you are having positions in companies that are likely to benefit from implementation rather than being enablers. So you think of enablers like SK Hynix, TSMC, NVIDIA, the picks and shovels providers, everyone's gone for those. I think you're seeing a bit of migration of capital into the enablers, but when you look at how these companies could take advantage of it, for example, Tencent, long runway for ad monetization. Not only that, higher monetization of ads. They can apply it to gaming. So I think if you extrapolate out 3 to 5 years, my view would be you're going to get a much better earnings profile to something like Tencent versus Alibaba, who's gone all into cloud, which is quite competitive. I have question marks around something like that, for example. So I'm quite cautious on AI and tech, but you have some exposures in the portfolio that I think are likely to, when rubber meets the road, deliver.
To be clear, the advantages with AI and advertising is that you can get data on individuals and groups and therefore be more specific with that advertising. Is that correct?
Broadly speaking, yes. You've already got a lot of granularity. I think the application for advertising would be to what you mentioned, how to make it more specific, more relevant, and therefore also how you can exhibit to customers a higher return on that advertising dollar, which would mean someone like Tencent could charge more, to keep it simple. Yep.
Let's talk about some of the other big opportunities that you see in Asia. Your fund has significant positions in Chinese consumer stocks. Does that make you a bull on Chinese consumption going forwards?
No. It basically positively disposes me and the fund to what you think will be structural winners in a, let's say, somewhat challenged part of the economy. So let me elaborate. When I go through Shanghai, Hong Kong, meet our analysts, besides going through their coverage list, what they like, etc., I always like to ask them, what are you doing? What are your friends doing? What are your relatives doing? How are they feeling? Are they confident? Are they worried? I think the confidence around the Chinese consumer was definitely shattered during COVID and after COVID. Lack of belief in the leadership, how they handled the situation. You've seen the economy head south since then. People are worried about incomes, job security, etc. That said, I think that confidence has morphed into being resilient. So Chinese people have savings. They're willing to spend. Their spending is much more targeted now. I'm going to go for an experience. And by the way, I'll spend more on that experience than maybe what I would have done in the past. But I'm going to save for a longer period of time to get there. I will go and buy a pair of trainers, but I'm not going to buy something for 500 renminbi. I might go buy 400 renminbi pair of trainers. So that's where I'm saying the Chinese consumer is resilient. When I look at the companies that are in the portfolio, the other aspect that I see is a disconnect between the way the markets price those companies and what I believe and our analyst believes they can deliver. So reading to that, I think sentiment has got too negative on certain companies within the China consumer space. Something like the Macau casino operators, for example, have been in the dumps until about 2 months ago, starting to rally quite considerably. Has the dynamic changed there? Is this short-term noise? Still trying to get to the bottom of it, but nonetheless, the market is telling you I think something has changed in that space. Another one that the fund owns is Anta, sports apparel. Okay, Chinese consumption I've just mentioned, let's call it resilient, but is there a thematic there? Yeah, post-COVID, people want a healthier lifestyle. They want more outdoor. This feeds exactly into that part of that subsector. So, there's opportunities to be had is the way I'd summarize it.
You're also overweight Indian financials. What's the attraction there?
Because no one likes it. If you look at it the last 12 months, it's definitely not been a sector that's been liked by the market. And that was the entree for the fund to increase exposure. So what the market was worried about, consumer stress, feeding through to non-performing loan credit cycle coming through, specifically on unsecured consumer lending. You had tightening liquidity in the Indian economy, leading to competition for deposits, which means cost of funding is going to go up, which means net interest margins are likely to be compressed. So the market there hit a brick wall about September. So the Indian market peaked around September last year. October, some of these dynamics started to play out. in particular, if you look at Cholamandalam Financial, we believe it's a long-term winner. Went from about 1,500 rupees per share down to 1,100 rupees in a very short period of time. Fund took advantage to increase exposure to that, and it's paid out quite nicely thus far. Again, Axis Bank came into the portfolio beginning of this calendar year, partly funded through HDFC Bank, which was a big relative outperformer. You're looking for additional exposure to financials, given the thematics that I've just mentioned, negative sentiment, NPL cycle potentially coming through, but not as bad as it could be for certain companies. Axis Bank fits that bill. Where it also ticks the box is relative to its peer valuation group, you are basically bubbling along rock bottom. 30 to 40% discount to the likes of HDFC Bank, ICICI Bank, which we think is unwarranted. So they're not really high conviction positions, but I think an area of the market that looks interesting.
The area that you do seem to have some conviction is in ASEAN, the markets there. Why is that, and how are you investing there?
So the exposures in ASEAN are really concentrating in Thailand. I still think it's a underrepresented part of the market from people's attention because they're just still absorbed in geopolitics, the China-US tariffs. They're still absorbed in AI. And, where's the catalyst for Asia? It's really hard to see. So the exposures that the fund has got would be C in Singapore, where it's headquartered, listed in the US, CPO, which is a 7-Eleven franchise operator in Thailand, and Bangkok Dusit Medical, which is a private hospital operator in Thailand. So just screening through the region before I came down here last week, at the aggregate level, so that the region looks fair value, but I was surprised to see that Malaysia, some of the valuation multiples for the Malaysian market are cheaper than the trough in 2008. That kind of is an outlying aberration. Is that an area of potential ideas? I think it is. We'll go do some work there. Thailand is a similar situation in that it's derated significantly. I think year to date, the market's down 30%. It's almost like the whole kitchen sink's been thrown at the Thai market. You've had tourists kidnapped, specifically Chinese tourists. You've had risks around Middle East medical tourism coming to Thailand. You've had political instability, which we'll see how it plays out. You've had an earthquake. So I just think less bad will be good for something like Thailand. To be upfront, the investments have been a detractor to performance, but you've just got to manage what percentage of the portfolio you're prepared to allocate to a thesis and how long you're prepared to wait for that to turn around. So we're into just passing the 12-month mark for both holdings. As a PM, you recognise sometimes you're early, which is the same as being wrong, which I've just pointed out. But there are ideas, I think, again, big disconnect between fundamentals and valuation. We're just going to wait for sentiment to turn.
Can you tell me a little bit more about C, which is headquartered in Singapore but listed in the US?
Sure. It's a combination of a few different businesses, so e-commerce, online gaming, and a bit of fintech. So maybe think of it as a Alibaba Tmall, Tencent Gaming or Riot Games, and a not pay now, buy now, pay now lender, for example. So short duration lending above market interest rates. So looking at the business, they operate in Brazil, Indonesia, Thailand, Vietnam predominantly. If I think about the valuation breakdown, 80% e-commerce, 20% for the remaining businesses. So I think what's interesting about it is you're getting a withdrawal of competitive intensity in the Indonesian market, which is the biggest market for them. The Chinese are too occupied fighting battles domestically. So Lazada, which is backed by Alibaba, retrenching a little bit. TikTok, distracted elsewhere. They've really been able to execute over the last few years what I think is a structural competitive advantage, which is they do their own logistics for e-commerce. No one else does that. So I think that's a strategic blunder Alibaba made a few years ago where they outsourced logistics. So very solid competitive position, both in Brazil, Indonesia specifically. What we're seeing is the market was not believing a turnaround in the e-commerce earnings coming through. We sensed that was an opportunity in the fourth quarter last year where the fund started building the position. And what we've seen is an inflection of e-commerce earnings Again, faster than the market anticipated. Fortunately for us, faster than what we anticipated. You also had positive earnings surprise from the fintech business, which this is kind of not speculative lending. This is lending to companies and consumers who are on their e-commerce platform. So they know your behavior, sizing up your risk profile. When we look at the credit metrics of their lending book, it's nothing abnormal there from what we can see. So that has been a pretty good winner for the portfolio.
Anthony, could you leave us with 2 thoughts for the listeners now? One opportunity perhaps and one risk.
Yeah, so in terms of opportunity, I would point to China specifically in the EM/Asia ex-Japan world. You've probably all heard the comments around, it's uninvestable and what we discussed earlier, tariffs and the like. The only problem with that is the market's reacting differently now than what it did, say, 12, 18 months ago. If I go back 12, 18 months ago, what was happening was bad news was sold into in China, obviously. Good news was aggressively sold into. I sensed a sea change in that back end of last year, and that seems to be the case. If you look at the market this year, it's up double digits year to date. So when I look at the sentiment that's changing in the market, where's liquidity shifting to, I do feel like there's been a change in the perception towards China. If you look at hard numbers, the market and stocks within those markets have really stopped derating. So you saw a steep derating 22, 23, but now kind of it's flatlining. So you're getting confirmation that, to a certain degree, maybe the worst is behind China. Still, I sense a lot of long-only investors are underweight China, and we'll take it from here. But within the region, I think it's actually an opportunity. The fund is overweight Greater China, looking at Hong Kong and China put together, about mid-single digits. In terms of risk, I think I wouldn't ignore what happened last year in Japan around tightening of monetary policy and the shockwave that sent through global markets. The point I'm driving at is, I think Stan Druckenmiller said it where, look where liquidity goes and that'll indicate to what markets are going to do or what stocks are going to do. What I'm driving at is if rates keep trending positively in Japan, does that start sucking liquidity from other markets? US, for example, right? The US exceptionalism example. Do you see a reallocation to Japan, for example? In a relative world, do you see EM and Asia ex-Japan start to outperform DM, which hasn't been the case for a number of years? So what I'm driving at is, monetary policy or financial repression policies, not only in Japan but elsewhere, could have massive implications to where liquidity flows. That's a huge risk. But within risk, there's also opportunity, which I've just pointed out.
And to explain that financial repression, you mean that Japanese inflation and rates are inflation is higher than rates, and therefore you get financial repression by governments trying to repress rates while inflation is going up.
Let me just answer it the way I think about it is, yes, you're right, inflation has been ticking up, rates are ticking up. Who's going to fund Japan without rates going up too excessively, which is your point of financial repression? So Japan has huge foreign assets. That's fortunate for them that they're in a surplus situation, like the US, which is in a deficit situation. And so that money will come home to, like you pointed out, try better manage the interest rate outlook for that economy. But again, that's going to have liquidity implications for many markets.
Well, that's a wrap. Thanks for coming in today, and it's been great to chat.
No, you're welcome.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.